Good afternoon and warm welcome everyone for joining us in today's webinar on India Entry Guide for Foreign Businesses, organized by Development of International Trade Services and WTO Directorate of ICI. We are delighted to have you with us. In today's globalized economy, India stands out as one of the world's fastest growing and most dynamic markets, presenting immense opportunities for foreign businesses. However, navigating its unique regulatory, tax, and cultural landscape can be a significant challenge for the companies. In this topic, India Entry Guide for Foreign Businesses is critically relevant for any international company looking to tap into India's vast potential. Understanding the correct legal structures, compliance requirements, and market nuances is not just beneficial, it's essential for a successful and sustainable entry. This webinar provides the important knowledge needed to turn opportunity into reality. It's my great pleasure to introduce our distinguished speaker, Mr. Manan Agrawal. Manan is a partner at Crayman Consultants, an advisory firm specializing in helping multinational companies navigate the complexities of Indian market. As a chartered accountant with over 18 years of rich experience, including a significant tenure at Ernst & Young, Manan has become a trusted advisor in this field. He possesses deep expertise in Indian tax and regulatory frameworks, corporate law, and foreign exchange control regulations. These are critical areas for any business looking to establish a presence in India. Notably, Manan heads the Japan desk at his firm and has authored several articles, including a highly relevant piece on setting up businesses in India by foreign companies. His practical experience in structuring investments and advising on tax efficient strategies make him the perfect expert to guide us through today's topic. Please join me in giving a warm virtual welcome to Manan, Mr. Manan Agrawal. Over to you, Manan. Thank you.
Hi, Smita. Thank you so much for the brilliant and kind introduction. I would like to share my screen, please. May I? Is my screen visible?
Yes, Manan, it's visible.
Good afternoon, and thanks to all of you for joining this webinar today. And without much ado, I'll start the topic. I have close to 53 slides approximately and a talking time of around 1 hour 25 minutes. I'll try to keep it brief. This topic is such which ideally requires around 1 full day to speak, but I know we have to limit the time. And this presentation today will hopefully give you a good insight into the business tax and regulatory overview of for foreign companies to do business in India. And while giving the presentation, I will keep shuffling between business, tax, regulatory, and my experience of serving multinational clients in India, more specifically from three jurisdictions, primarily Japan, US, and Vietnam. With this, I would like to start the presentation. First of all, let's talk about the FDI in India, the Foreign Direct Investment Policy in India. We will go to the basics of FDI a bit later, what constitutes automatic route of investment for foreign investors in India, what constitutes government approval route. But basic insight into stats, the statistics, I think is relevant. So the total FDI in 2024-25 was USD 81.04 billion, 14% growth compared to 23-24, which around 10 years back was around 36.05 billion. So you can see there has been a jump of more than twice double increase in the FDI in India. The top sectors which have been receiving FDI, primarily services, IT, and trading at 19%, 16%, and 8% respectively. The top recipient states have been Maharashtra, Karnataka, and Delhi. And the top source countries, the investing countries, have been Singapore, Mauritius, and US. Now, the investments coming from Singapore and Mauritius, we need to understand that these are not the countries which house the brand owners. Singapore and Mauritius, they are the seat for private equity funds. So the investments coming through Singapore and Mauritius mainly belong to either Americans, Japanese, or Europeans. Essentially, if we see the primary countries which have been investing into India traditionally have been US, Germany, France, Japan. Now, talking about the policy and regulatory reforms. In the last 10 years, there have been significant liberalization of the FDI policy. On the slide, you can see the breakup of last one decade into two parts, 2014 to 2019, and thereafter 2019 to 2024. So if we run through it, a brief snapshot, let's talk about each sector wherein the FDI policy has been liberalized. In defense, up to 2020, FDI was allowed maximum up to 49% under automatic route. But now FDI is allowed 100%, wherein up to 74% it is allowed under automatic route, and beyond that under government approval route. In insurance, in 2015, a total FDI was allowed up to 49%, wherein up to 26% was allowed under automatic route, and beyond 26% was allowed under government approval route, which now this year has been increased to 100% under automatic route. In the pension sector, in 2020, FDI up to 49% was allowed under automatic route, and in 2021, this limit was increased to 74%, again under automatic route. In construction development sector, there were restrictions in terms of minimum land area which needs to be developed by a foreign investor, minimum built up area which needs to be developed, and a minimum capitalization requirement of $10 million for wholly owned subsidiaries in India and $5 million for joint ventures. So construction development is a sector in which FDI was allowed way back in 2005. And we saw many construction development companies uh, coming to India, or overseas companies like MR and all those companies. The Here it's necessary to understand the difference between construction development and real estate. So FDI is not allowed in real estate sector of India. FDI is allowed in construction development, but not real estate. The difference is that when we say construction development, it means that the foreign investor is supposed to develop meaningfully, use the resources of the country, develop a project, and then sell it. And but real estate typically means buying and selling of land. So FDI is not allowed in mere buying and selling of land. But yes, if there is a meaningful intent to develop a project, infrastructure, residential, commercial, then that is what construction development means. In contract manufacturing in 2019, FDI under 100% automatic route of was allowed. In civil aviation till 2015, within ground handling services, 74% up to FDI up to 74% was allowed. Now 100% is allowed under the automatic route. In single brand retail trading till 2019, 100% was allowed, automatic up to 49%, and government approval was required for any investment beyond 49%. But now 100% investment in single brand retail trade is allowed under the automatic. Space sector, again, a very developing area, operation and establishment of satellites. Earlier, any investment in establishment and operation of satellites could be done only with prior approval from the government, 100% under government approval route. But now, up to 74% FDI can come under the automatic route in establishment and operation of satellites. Any investment beyond 74% is still under government approval route. Now, when we talk about FDI, let's see India as from the eyes of a foreign investor. India is 75 years old. We have had a history of colonial rule before 1947. We all know around 400 to 500 years we were ruled first by the Mughals and then by the British. So the actual age of India is since 1947 only. So we can easily say that we are just 75 years old as an economy. Within this 75-year-old economy also, economic liberalization started in India as long as 1991 itself. Prior to that, there was the more of a feeling of Swadeshi, I would say. In 1991 is when the foreign investment was allowed in India, which is around 35 years back. But since then, so many companies, overseas foreign companies, have set up their shops in India that today we don't even know that so many of the brands that we are using are actually not Indian brands. For example, a very simple commercial products, Mami Poco pants, the diapers, baby diapers. That's a Japanese brand. Many of us may not even know that. Similar for many other brands also. In 2013, India stood 15th globally in terms of FDI. In 2014, we stood 9th. The year 2015 saw a sharp growth in FDI when we overtook China and US as the top destination. In first half of 2015 alone, we received $31 billion of FDI compared to $28 billion received by US and $27 billion received by China. Now, how does this work? How from a business perspective, the way I have seen it, especially again, I would like to refer to Japanese. There is a slide in this presentation which talks about the growth of Japanese companies in India. So in 2007-8 around, there were 267 Japanese companies only in India, which currently are around 1400, which means a 6 times increase of Japanese companies. So how they have grown in India? First, you have a very big company from maybe a Japan or a Korea or a France or a Germany set up their presence in India, say maybe a Hitachi or a Toshiba or a Honda. And after they set up their shop in India, their supply chain also start setting up their shops in India. And that is where the opportunity lies for us as professionals, whether we are in industry or in practice. It opens up job opportunities, it opens up consulting opportunities. So you have one Honda setting up presence in India. Thereafter, the original equipment manufacturers, the supply chain, the spare parts manufacturers, the service providers who have been supporting Honda in Japan and who are who belong to the medium and small category, they also start setting up their legal entities in India. Because Honda is accustomed to using their spare parts, its existing vendors, spare parts, and services. So that is how these small and medium companies, the supply chain partners, also come to India. And when that starts happening, 3 particular kinds of organizations have a very important role to play in facilitating cross-border trade and investments. First is the banks. So if we talk about Japanese, there are 3 mega Japanese banks in India. And since funds transfer have to happen, capital infusion has to happen, repatriation of profits have to happen, banks play a very important role. There are about 106 AD banks, authorized dealer banks in India, which have been nominated by RBI to act on their behalf to facilitate foreign investments into India. Second is airlines. And third is logistics. So logistics could be a custom house agent or these trading partners, distributors. They they also start setting up their legal entity in India and start facilitating trade. So FDI into India is facilitated by these three kind of organizations. Thereafter, within the service industry, you have HR companies. We are seeing Japanese HR companies, Japanese recruitment companies, other service providers, media partners. They also set up their presence in India. Business centers, art and culture foundations. We have Japan Foundation in Lajpat Nagar. So these, as and when people grow, the natives, Japanese natives grow in India, there is an opportunity for all of us there to cater to those kind of organizations. If we talk about Vietnam, I've been working recently with Vietnam Trade Office in India, and it's interesting to know. I don't know if any of you are aware of it, but recently a very big Vietnamese company has established its presence in India. It's called VinFast. We could compare it to a maybe Tesla of Vietnam, but it's a very big Vietnamese company, and it is listed on New York Stock Exchange. It has set up a manufacturing plant in Tamil Nadu, and it has signed agreements with to open showrooms in I think around 28, 29 cities of India. It is moving very fast, and I think two models V6 and V7 have already been started to manufacture in India. So along with VinFast, this could be the start of Vietnamese investments into India. Now, hopefully, their vendor supply chain partners will also set up their legal entity in India. We have been receiving many requests from small and medium Vietnamese companies to set up their presence in India. I hope I have been able to explain that how a whole new ecosystem is facilitated to be set up in India as a result of one big giant from a particular overseas company setting up presence in India. We could also talk about Amazon. We could talk about Kia Motors. We could talk about Samsung. The list goes on. But this one big investment helps in setting up of lot many smaller investments into India. Now, what are the reasons for investing into India? One of the largest producer and global markets, consumer markets globally. So we represent around 17% of the global population. Scope for digital technology driven business. Earlier to the British, we were known as the land of snake charmers, but now to the Americans, we are known as the land of engineers. And we know that we have a lot of potential in producing good engineers who are capable to run digital and technology driven businesses, not only in India, but even overseas. Availability of land and manpower. So India is the seventh largest country of the world, and we know it's the most populous one as well. And so there is a lot of land area for setting up manufacturing operations. Like again, this how it works, how the synergy works. If we talk about Japan, around half the Japanese companies in India today are manufacturing companies. Japan has technology and capital. India has land and manpower, and these four are the main resources to set up any manufacturing presence in any country. So we see how this synergy works. One country has what we need, and the other country has, vice versa. Young working population, around more than 65% of Indian population is below the age of 35 years. Easy accessibility through sea and air. This again is a very important factor for foreign companies. We are a peninsular region with three sites covered by water. There are both seaports and dry ports, and cost of the goods being shipped from overseas, at least if we see the eastern regions, Southeast Asia, the cost of final product is lesser when ocean freight is involved, when goods are shipped through sea and not by air. So that also adds as an added advantage for foreign businesses when they are supplying goods or materials to India. Now we talk about FDI policy of India. I know we have already discussed about FDI without going into the conceptual part of it. Let's just briefly touch upon the uh, conceptual part of FDI for the ease of those for whom it is really new. So FDI in India can be allowed under two routes. One is automatic route and other is government approval route. By automatic route, it is meant that no prior approval from the government of India is required. And by government approval route, it's meant that prior approval is required from the government of India. So when we say automatic route, of course, to set up a company, you need to undergo the registration process with Ministry of Corporate Affairs. That is another thing. But in principle, no prior approval is required. Most of the sectors in India, more than 95% of businesses and sectors in India, whether it is across services, trading, or manufacturing, because broadly these are the three areas, right? Services, trading, distribution, and manufacturing. So investments across all these three verticals are allowed under the automatic route. In government approval route, only some of the sectors are covered, which are sensitive. And some very just four or five sectors like gambling, betting, and all, I think in those sectors, FDI is prohibited. We have a list in this presentation which talks about the sector-wise FDI caps for each industry. FDI from China, neighboring countries, this is relevant. This happened in 2019, or rather 20, I would say. The press note 3 issued in 2020 by the RBI when COVID had just struck, and in order to prevent opportunistic takeover of Indian companies by Chinese, let me be very upfront about it. Uh, this is what the government had come up with, this press note. It says that the for any investment coming directly or indirectly through China, that needs prior approval from the government of India. And the term China was not mentioned in the press note, of course, but it was mentioned as any country sharing land border in India, which obviously includes China, Pakistan, Afghanistan, Nepal, Bhutan, etc. And we can also recollect, I think many of us, many fintech apps were banned in the year 2020 to 22, that era. Around, I think, 120 fintech apps were banned. Those kind of apps which were making loans easily available, 1 minute loan, 2 minute loan. Most of the investments, those apps were from China and they were overnight banned. And even today, the bankers may confirm it, but as per my understanding, not more than 10% of investment proposals from China are approved. So government is actually not appreciating Chinese investments anymore. And I think this is common not in India but in other countries also. This is a similar situation, and this again leads to an opportunity for us as professionals. Now we need to understand here that there has been a China plus one strategy. Means the COVID taught us that global companies, businesses should diversify their risk by concentrating, not concentrating everything in China. But we still today, even today, we have a lot of competition. Let's see ourselves from perspective of foreign investors. All right, even if you do away with China, first of all, it is honestly speaking, it is difficult to meet with the benefits, the cost arbitrage that China offers. But we do have competition from Vietnam, Thailand, Singapore, Mauritius, and Philippines, other Asian countries. So while India offers a lot of potential, there are practical challenges also involved from investors' perspective, which we need to take care as partners in nation building. The government needs to take care. We'll talk about it towards the end of the presentation. What are the common issues and pitfalls that investors face, and what we also face as professionals when we are serving the multinational companies. This slide talks about sector-wise FDI limits. So you can see that within agriculture, animal husbandry, plantation, mining, PNG, most of the sectors you can see they are covered 100% under automatic route. Defense, automatic route up to 74% and beyond 74% in the government route. Broadcasting of news, that is a sensitive sector. Upstreaming, streaming of news and current affairs through digital media, only 26% is allowed under government approval route because I think it's very sensitive for the government. Here also, practically again, leave alone FDI one side, but the image of India, right, before the foreign investors, it's different from what we see on televisions. Okay, we see on television the news channels of India, but the image that the foreign investors have, they are very different. I'll not talk much about it, but I think our media should actually propagate news image of India in a more positive manner. I don't know how they do it, but overseas companies, I have had many interactions with them and they have mixed opinions about India. So our media sector really needs to work on this front, I think. Any which is coming back to FDI. I think this presentation will be shared later, so I'm not going into each and every sector in detail right now, just covering broadly. Within e-commerce, within marketplace-based model, 100% FDI is allowed under automatic route, but in inventory-based model of e-commerce, FDI is not allowed. I think the reason for this is the representations made by Indian e-commerce companies as a result of global e-commerce giants tapping the Indian market in a very short span of time. So if you're running if you're just running the portal and doing the job of making the buyers and sellers meet, then FDI is allowed in that. But if you're controlling the inventory which is being sold on your portal or e-commerce platform, that is something which the government is not allowing FDI to come in. There are some issues around it. I don't know if the e-commerce policy of India has been released or not, but I think it was supposed to be done. But there are hues and cries around it. I mean, lack of clarity on this part. Within a single brand retail trading, 100% is allowed under approval route. In multi-brand retail trading up to 51% is allowed under government approval route. Railway infrastructure, very important. 100% is allowed under automatic route. So if a foreign investor wants to work around the railway infrastructure of India, you want to develop the railway stations, please go ahead. You want to build railway wagons, please go ahead. You want to make the terminals, Shinkansen project, a very good example. The bullet train project from Japan, very nice example of FDI into railway infrastructure. Operations, of course, leave alone FDI, railway operations is something where even private participation is not allowed. So FDI, of course, cannot be allowed there. But railway infrastructure is a big area for foreign investments. Again, here on the screen, you see most of the sectors are those in which automatic route investment FDI is allowed. Make in India. So, Make in India is something which our Honorable Prime Minister launched in September 2014. I think it has helped to a large extent, but not as large as it was anticipated. One of the reasons, of course, was COVID. And now, last year onwards, the shift has been towards setting up of global capability centers in India. Our institute has been doing a lovely job in propagating and telling the world about how Indian chartered accountants can help in setting up of GCCs in India. I think there are around 1,800 global capability centers in India, employing more than 1.9 million professionals. And till now, the GCCs in India, they were mainly limited to back office operations or accounting compliances, those kind of tasks. But now, even the new areas like data privacy, marketing strategies, AI, talent development. They are the core areas relating to business. For that also, GCCs are being considered to be set up in India. Few days back, we received request from a Japanese company wanting to set up an R&D automobile R&D unit in India. So around close to 5% of the existing 1,800 GCCs in India are Japanese, and more and more automobile R&D companies of Japan, they are gradually considering to set up their presence in India. One of the GCCs, like you might know, Renault Nissan, is already there in Tamil Nadu. And now even the automobile part manufacturers, not just the main company or the parent company, even the part manufacturers who do R&D currently, they might be having facility in China or Thailand or Vietnam. They are exploring to set up GCC in India, which is a very nice thing for us as a country. And but then again, if we talk about GCCs, we have competition from Middle East because there are lot many GCCs which are being set up in Middle East as well. So we are strong, but we are not alone. You need to remember that. This slide talks about presence of Japanese companies in India. I talked about it a few minutes back. As you can see, in 2006, there were 267 Japanese companies, and now there are 1,400 Japanese companies. This slide gives the data till 2022 only because after that there has not been many significant increase as such. And I mean, some companies, there are Japanese companies, new Japanese companies which have set up presence in India even after 2022, but then there are some which have packed their bags and left also. So the total number is still around 1,400. And if you talk about the number of people, because ultimately it's people who develop the business, so there are currently about 10,000 Japanese natives living in India, which includes the expatriates who are coming from Japan to India, their families, etc. And there are about 40,000 Indians living in Japan. So legal structures and procedure to set up a business entity in India. I just hope that if I could have one word from maybe Smita or from Gunjanji, that I hope I'm being able to communicate so far. Or if there are any inputs which I need to keep in mind in my presentation going forward, I'll be happy to do that. Do you think I'm being able to communicate, Smitaji? Just your thoughts, just probably.
Manan, surely your presentation is going very well, and I think it's on right track. You
Thank you
can
so much.
please continue.
Thanks a lot. So I'm on slide number 14. I have another, I think, 45 minutes to go. Try to keep it brief as much as possible. So what are the entry routes available for a foreign investor? A foreign investor can come in India in two alternative ways. Either it can set up its own legal entity in India, which is called organic growth, or it can grow inorganically, which means it can acquire any existing business in India through merger and acquisition route and thereafter run its business. There are pros and cons of both. The risks are higher. If the foreign investor goes for an organic form of entity in India, sets up its own business, then the risk is higher, but then the rewards are also higher. They get 100% of the profits. And similarly, vice versa. And if you set up if you acquire an existing company in India, there are certain challenges attached to it, but then there are certain benefits as well. If I talk about the challenges, it's not easy to run a partnership. If we talk about a JV or something like that, and if you're acquiring an existing company in India through acquisition route, there might be a history attached to that company, which may or may not be that much good. You can do as much due diligence you want, the foreign investor, but the possibility of ruling away all the risks is never zero. So in this presentation, we'll focus more on the organic growth for foreign companies in India, less on the inorganic growth. I have one slide on inorganic growth, but primarily we'll be talking about setting up their own legal entity in India. So here, when we talk about the corporate, when we talk about the form of corporate entity in India, there could be setting up of a separate independent entity, or it could be setting up of a non-corporate entity. Within the corporate form of entity, the foreign investor can have a wholly owned subsidiary, a joint venture, or a limited liability partnership. And within a non-corporate entity, it could have a liaison office, corporate office, or project office. About each of these different forms of legal entity, we will talk in the next slides. But basic difference we need to understand is very important. The private limited company or LLP is treated as a distinct legal entity in India, having the status of an Indian resident in the eyes of law. Whereas a liaison office, branch office, or a project office, they are treated as extension of the parent company in India. So their residential status is also that of a non-resident. And there are different purposes for each of why private limited or when a private limited company should be formed, when an LLP should be formed, when LOBO should be formed. Let's talk about liaison office or a representative office. It's also called sales office very often, and it is a known form of legal entity in many countries, most of the countries globally. So an LO can be set up by a foreign company in India when it wants to do some market research about India. And an LO, as per the RBI guidelines, is allowed to act only as a communication channel between the foreign parent company and Indian companies. An LO is not allowed to undertake any commercial activity in India, and hence an LO does not create a taxable presence in India. Here we need to understand that this is very important. The prohibited activity for LO. It's not allowed to undertake any commercial activity in India, but if it lands up doing any commercial activity in India, then it will create a taxable presence, of course, because that would be violation of the RBI regulation. So if you have a client which is running an LO in India and they are sitting relaxed that they can never form a taxable presence in India, that may not be the right presumption. The activities that the LO is doing in India is very important. And we, as the statutory auditor, if you know about it, there is something called an annual activity certificate, which the statutory auditor has to provide to the RBI. And there we mention that the LO has not done any activity in India which is in violation of RBI regulation. So please be careful. Whoever is doing audit for an LO in India, make sure that the activities of the LO are within the limitations which are mentioned in the RBI approval letter, and the LO does not do any activity beyond that. If it does any activity beyond that and you are mentioning it in the annual activity certificate that the LO is compliant with the RBI approval letter, you need to be very careful about it. The approving authority for an LO is RBI or the AD Bank. Here, we need to understand that RBI has decentralized the power of granting the power of granting approval for LO to the AD Bank. So I'll talk about it a few minutes later when we talk about the process. The criteria, this is very important. The minimum net worth criteria that parent company should have at least $50,000 of net worth, and this is and here a profit making track record of at least 3 previous years. If the investment is coming from a company which is maybe based in Singapore or Mauritius, which is just a holding company and doesn't have sufficient net worth or profit making track record, and which the ultimate beneficial owner is any other brand owning country, maybe US or France or Germany, then a letter of comfort has to be given that this company, which is setting up the LO in India, that Singapore based company or Mauritius based company, it is backed by the parent company, and any fund and all the survival of that Mauritius or Singapore based company is not based on its own audited financials, but this mean of sustenance is the parent company. So that, as the term suggests, the letter of comfort needs to be submitted to the RBI. The life of an LO is typically 2 to 3 years, and after that, it can either be continued with, renewed, the license can be renewed, or it can be upgraded to a branch office or wholly owned subsidiary. BO, the main difference between LO and BO is that BO is an upgraded version of LO and it is allowed to undertake commercial activity in India. The only prohibition for BO is that it cannot undertake retail trading activities in India, local procurement and sales. It cannot undertake manufacturing and it cannot undertake construction development activities in India. Remaining the process for granting approval, obtaining approval in case of BO, the process for registering a BO with Ministry of Corporate Affairs is the same as that of LO. Um, the eligibility criteria is a bit different. The minimum net worth is $100,000, which was $50,000 in case of LO, and a profit-making track record of at least 5 previous years, which was 3 years in case of LO. And profits earned by BO can be freely remitted back to the parent company after payment of applicable taxes in India. Project office is relevant for infrastructure-based companies or engineering, procurement, construction-based companies where they have received a contract from an Indian company which has a limited life. In that situation, it is project office is usually set up because setting up of a private limited company and then winding up within a period of 2 years or 3 years is very cumbersome. So government has allowed to set up project office in that situation. Like give an example, we supported a Vietnamese company which was making the new building for Vietnam embassy in India. So we helped them set up the project office in India, and these are the kind of projects for which PO is preferred instead of LOBO or a private limited company. Wholly owned subsidiary is typically a private limited company. This is the traditional form of doing business in India for both Indian owned companies as well as foreign owned companies. We know that, I mean, there's nothing much to talk about in this slide. I think all of you know it. The activities can be done as defined in MOA and AOA, memorandum and articles. But yes, of course, they have to be compliant with the FDI regulations. You cannot write in your MOA that you will undertake activities in India which are against the FDI policy of India. That would be void ab initio. So the only thing that you need to keep in mind is that the activities are in uh, alignment with the FDI regulations, and there are certain regulations regarding resident director, 182 days requirement in India, that will talk in the next slide. LLP, again, we know what an LLP is, and typically it is popular in service-based industries, though there are foreign companies which are doing trading in India through LLP form, but it's more prevalent within the service-based industry. One important point of distinction between private limited and LLP, in case it helps you for your clients or the company that you're working for, a private limited company is entitled to raise external commercial borrowing loan from overseas parent company, but LLP is not. So if you're intending that your legal entity in India, the foreign investors legal entity in India, must be able to raise loan capital, then please ensure that you form a private limited company and not an LLP, because that's not allowed as per our regulations. Now we talk briefly about the key regulations: taxation, forex, compliance, repatriation of profits, and money transfer. Set steps for setting up of an LO or BO in India. First, you prepare a detailed action plan, which is likely to take 2 to 3 weeks. Obtaining approval from the RBI bank, this takes around 3 to 6 months. But here, one thing is very important is the notarization and consularization. They also call it legalization of documents in the home country. So there are certain countries where it is less time consuming to obtain notarization and consularization of documents, and there are certain countries where it takes a lot of time. So if I talk about my experience in typically in companies from US and Japan, they do not face that much of a problem because they know what document how the processes works. But in case of Vietnamese companies, there is a lot of problem in getting documents notarized and consularized in Vietnam. So when we have asked clients to send their KYC documents notarized, consularized in US or Japan, we have received it within a couple of weeks, 2 3 weeks. But from in case of Vietnamese companies, it has taken 2 to 3 months to receive notarized and consularized documents from Vietnam. So this time period is really dependent on how much time the company takes to get the things notarized and consularized in the home country. Then registration of LOBO with MCA and obtaining initial tax registration. So here how the process works for LOBO, the applicant he submits the application with an AD bank of his or her of his choice. The AD banks does a due diligence of the documents to see if it's all fine or not, and then once it is satisfied, once the AD bank is satisfied, it uploads the document on an internal portal for RBI to generate a UIN, unique identification number. Then RBI, if it doesn't have any queries, then it generates the UIN and gives it to the AD bank, and then the AD bank sends the letter of approval to the applicant along with the RBI's letter, that UIN number. So this whole process, filing of application along with supporting documents from the applicant or the foreign company to AD bank, then AD bank approaching RBI, RBI giving the UIN to AD bank, and AD bank passing out on to the applicant. This whole process takes nowhere less than 3 to 6 months. And here it's also depends on which bank you are choosing. So be very careful of the AD bank you choose, because there are AD banks I know which have granted approvals in 1 month, and there are AD banks which have taken as long as 6 months. So we need to be careful about the AD bank we choose. And after the RBI approval letter is granted, they give a period of 6 months to register the LOBO in India, form it in India, and then obtain the certificate of incorporation from the Ministry of Corporate Affairs. If that activity is not done within the period of 6 months, then the approval lapses. Important requirements. The LOBO must identify an individual who will act as the authorized representative of the LO or BO in India. So this individual, it is akin to a director in a private limited company or a partner in an LLP. This individual must be a person who has stayed in India for at least 182 days, which transpires to almost 6 months during the relevant financial year. In case of a newly incorporated LOBO during a financial year, this limit of 182 days is calculated proportionately. So, for example, how this calculation works, if an LOBO is incorporated in India, say on 1st April 2025, that means it will be in existence in India for full 365 days in a year. And the authorized representative, the individual, it could be Japanese, American, Indian, Vietnamese, whoever, the citizenship does not matter. What matters is the number of days stay in India. That person should be in India for 182 days. Now, say the certificate of incorporation is uh, granted on 1st October 2025 for the LOBO. In that situation, that the LOBO is in India for half the year only, right, in financial year 25-26. So this requirement of 182 days also becomes half. It becomes 3 months. That means during this financial year, whoever the individual is who will be registered as the authorized representative and will be responsible for all the actions of the LOBO in India, this AR or authorized representative has to be registered with the Ministry of Corporate Affairs. So his role is very important, just like a director in the company. That person should be in India for uh, half the period of 6 months, which is 3 months. And similarly, if the certificate of incorporation is granted on 1st January 2026, that means this period of 6 months will become 1/4, which is 3 months by 12 months. So that person needs to stay in India only for 45 days during FY 25-26. This calculation is very important, especially in the first year in which the LOBO is set up. Thereafter, once it has come into existence, then obviously for every subsequent year, the requirement will be for 6 months only, and it will not change. The address, which will be the registered office of the LOBO in India, we know that when all the communications, they are coming at the registered office address of the entity. Important requirements. Once the LOBO is incorporated, it has got the certificate of incorporation from the Ministry of Corporate Affairs. Then it has to open the bank account in India, and the head office needs to infuse the capital money into the bank account, and all the expenses relating to the LO or BO, such as salaries, rent, administrative, audit fees, professional fees, etc., they must necessarily be met from that bank account in India. Here we have seen practical issues with some companies, especially from Vietnamese companies. They set up the LOBO in India. It took 1 year to set it up. And after that, they found it difficult to transfer the money from their home country to the Indian bank account. And what they did was they were continuing to make the payments from the home country to the vendors in India, which is absolutely not allowed. So when we talked about making a detailed action plan before setting up an LOBO in India, it's very important for the foreign investor to be made aware and educated that after you set up the LOBO in India, make sure that you transfer all the expenses are met through the bank account of the LOBO in India, and no expenses relating to that LOBO for purpose for which the LOBO has been set up should be made directly from the parent company to the Indian vendors. That is a strict no-no. Documents required for obtaining approval from AD Bank, RBI, the parent company certificate of incorporation, MOA, audited financials for last 3 years or 5 years, bankers report from foreign bank showing the number of years for which the parent company has relationship with that banking company, PAN, passport, address proof of the authorized representative, request letter, form FNC. It's a form FNC is the form which is prescribed by the RBI regulations. It has all the details like which company is setting up, the name, detail, phone, all those stuff. How much of exports they are doing to India, or rather, how much of imports. You can call it either ways. Let me call it export. How much? What is the value of exports that the foreign companies are doing to Indian customers presently? Because then when do foreign investors they want to set up a legal entity in India? Typically, when they already have a customer base in India, that is the usually the situation in which foreign companies start exploring about setting up of legal entity in India to grow the business, to provide good customer service to the clients in India. So FNC has many such details. It talks about whether the directors or the of the home country, the parent company, whether they have any criminal history or not, their whole parents, KYC, all those things are mentioned in the form FNC. Board resolution, power of attorney, etc. There's a declaration which needs to be given out of FEMA, a CPA certificate which mentions the calculation of net worth. Remember we talked a few minutes back, $50,000 and $100,000 in case of LO and BO respectively. So whether that calculation has been made as per RBI regulations or not. Then of course the registration of once the RBI approval is granted, then the documents for registration of LOBO with MC are typically similar to that for Indian company. List of shareholders, directors of parent company, address proof, etc. NOC from owner of the premises, latest copy of utility bill, etc. All the documents, all the documents which are executed outside India, they must be translated into English and notarized and consolidated. This is what takes a lot of time. And like for example, the audited financial statements for 3 years. Each year, we have seen that the audited financials are not less than 25, 30 pages, and they all have to be translated into English. So first, the foreign company has to get it translated, then it gets notarized and consolidated. So we can understand the reason why it takes time for legalization of documents in overseas countries. Formation of wholly owned subsidiary in India. This is the process is we know the process for company formation in India, so I'm not going into the details there. What we need to understand exceptionally here when it comes to foreign investors is that after the certificate of incorporation is received, it's important to remit the funds. The capital infusion must happen within 180 days or 6 months of the incorporation of the subsidiary. And an FCGPR form has to be filed with RBI within 30 days of allotment of shares. Again, the requirement for directors of wholly owned subsidiary company needs to have two directors. at least one of the directors should be in India for at least 6 months, similar to the rule that we discussed few minutes back. So again, here is an opportunity. If you know any company which is doing business rightly, ethically, and you want to be the director, many of us as professionals are already on the board of directors of listed companies in India, but here you have an opportunity to be a director on the Indian board of the foreign company. Be careful which company you take up the directorship of. Do not take up the directorship of any hanky panky company. See their website. If it's listed outside India, then it is fine. The registered office requirement is there. Infusion of capital money, of course, similar money. All once the subsidiary is incorporated in India, all the expenses needs to be met from the Indian bank account. All the necessary taxes has to be paid in India. Dematerialization of shares. This is something relatively new, not exactly new. It's close to 1.5 years old now. But subsidiary of foreign company, it does not fall within the uh, definition of small company. So it is necessary to obtain dematerialized shares. This takes again a lot of time. We'll discuss why. On this slide you're seeing is just about the ISIN. So the subsidiary in India that needs to obtain an international security identification number, which typically takes 3 to 4 months. This slide that you're seeing talks about the steps. Now we are talking about dematerialization of securities from perspective of subsidiary of a foreign company. All right. It's different when we talk about a normal company, normal Indian company, which is owned by Indian promoters, and vis-a-vis an Indian subsidiary which is held by a parent company located outside India. The process, the practical experiences is very different. In the first 4 steps that you see in orange, they are the requirements which need to be done by the Indian company. So that is not much difficult, I would say. What is actually difficult are step 5 and 6, because you need to get the demat account opened in India for the foreign company. Obtaining the KYC documents from them, asking them to fill the account opening form, the coordination we have to do with the registrar and transfer agents, the depository participant with NSDL, CDSL on behalf of the parent company overseas. That coordination takes a lot of time, but then it is a legal mandatory requirement, can't help. And then finally, once the demat account is opened in India, then you have to submit a demat request form, attach the physical share certificates, and it gets converted into electronic shares. So step 5 and 6 is something which takes a lot of education and awareness to be propagated by us to our foreign investors. Documents required for forming WS in India. Again, this relates to the company formation process. Won't be going much into detail. NOC from parent company for use of name in India. That is required. So if we have a Toshiba Japan setting up Toshiba India Private Limited, then NOC is required from the parent company. All documents translated, notarized, and consularized. Here, pursuant to the press note 3 coming in 2020, which we discussed few minutes back, where all the approvals of all investments coming from China. So after that, the process has become a bit cumbersome, I would say, because we need to give declarations to the MCA and RBI about ultimate beneficial owner. And they take all these press note 3 declarations that no investment is coming from China. So to convince the parent company, sometimes they have seen that in case of Japanese clients, they took it otherwise also, that are you not believing that we are a proper Japanese owned company? Are you suspecting that we are held by Chinese? So this kind of thing, then you have to say, no, 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 this is not what we are saying. This is an RBI requirement. That again, these are practical issues which come up when you are giving declarations for press note 3 to the RBI or Ministry of Corporate Affairs. Taxes in India. So we know there are direct taxes, income tax mainly, and indirect taxes may we have customs and GST. Some concepts relating to income tax. tax year, of course, we know April to March. Double taxation avoidance agreement between India and overseas jurisdiction. India has DTAs with close to, I think, 96 countries or something. And the as per the Indian Income Tax Act, the provisions of Indian Income Tax Act or the treaty, whichever is more beneficial, applies typically to a non-resident. Then, when there are many issues in international tax, some of them for our Japanese clients, we have a slide on that. I'll talk about it later. There are many cross-border tax issues. I don't know if you have time to discuss that, but then these are the things which we need to be aware of when we are working for foreign companies. Transfer pricing, all right. The transactions should be at arm's length price. BEPS, there is no shifting of profits from India to overseas. Foreign tax credit, very, very important. The manner of claiming it, Form 67, and so that the company doesn't land up paying taxes in two different jurisdictions. Permanent establishment, the foreign company should ideally not constitute a P in India. Form 10F requirement, tax residency certificate requirement. All these things are something which we need to be aware of if we want to advise foreign companies on doing business in India. This table it tries to give an snapshot of the effective corporate tax rate. So first column you see is LO, or the form of legal entity. Sorry, this is not rate. This should be form of legal entity on profits earned in India and on repatriation of profits. In case of LO, no profits are ideally should not be earned in India, hence no tax. BO is typically taxable at 35% plus surcharge and cess. So that comes to this range 36.4, 38.22, maybe around 37%, you should say broadly. And on repatriation of profits, when the branch office is paying back profits to home country, it is ideally non-taxable in India because we discussed a few minutes back that BOA is treated as non-resident in India. So the question of taxing the head office again in India doesn't arise, and hence the tax rate applicable to BO is also that of a foreign company, which is 35% plus surcharge and cess. Only on subsidiary, if it's a private limited company, the rate is 25% plus surcharge cess if the turnover is less than 400 crores. And there is an additional tax of 10% to 20% on repatriation of profits. Profits can be repatriated from the Indian entity to the parent entity through four typical forms: dividend, interest, royalty, fee for technical services. If the foreign investor belongs to a country with which India does not have a double taxation avoidance agreement, then the tax rate is 20% plus surcharge and cess as per section 115A of the Income Tax Act on these four passive sources of income. If the foreign investor belongs to a country with which India has a double taxation avoidance agreement, then the rate in DTAs are usually 10% to 15%. But yes, the foreign investor must have a tax residency certificate issued by the government authority of the parent company, and also it should file Form 10F in India, which now the process has become online. And if it is a wholly owned subsidiary, then the tax rate is 30% plus surcharge and cess. The good part is that it is not taxable in the hands of the parent company because I guess exemption under Section 10 is available. Share of profits in an LLP is not taxable. So broadly, if we see the crux of this slide or the tax rates, effectively for the profits to be earned in India and thereafter repatriation, it comes to around 35% to 37%. Now, here is where the tax planning lies, whether the company wishes to retain profits in India for a long time. If yes, which is many a times are true, then it is better to set up a private limited company in India. It is also called a PE blocker, permanent establishment blocker, because a BO always creates a PE in India, but a private limited company, assuming the decisions and all are taken in India by the directors, it typically does not form a P unless, of course, the proper documentation is placed and the substance over form concept is also being followed in relation to the decision making authorities and processes. GST, we know about GST, nothing much for me to talk about. Common tax issues, this is a snapshot. I mean, since we are dealing with many Japanese companies, the issues which they have been facing in India, it's a slide deck on that. 1A, if you see, is GST on salaries paid to foreign expatriates working in India. So if we see Americans, when they form a subsidiary in India, usually the Indian MD that they appoint is an Indian individual, not a foreign expatriate, usually. But if we see Japanese, they have a very common practice of sending an expatriate who will act as the managing director of the Indian subsidiary. And in this decision, which was I think, May 2022 or 23, the decision of Northern Operating Systems, wherein it was held that salaries paid to expatriates is liable to service tax. That was Supreme Court decision. And ever since that decision was issued, irrespective of the facts of each case, the GST department started issuing notices to many Japanese companies asking them to deposit GST in India on salaries paid to expatriates right from 2017. So you can understand the quantum because as it is, the salaries paid to expatriates is much high, and 18% on that for 5 years. The liability was running into crores. And of course, there were many issues revolving around it, whether input tax credit will be allowed or not. But that created a lot of hue and cry for the last 2 to 3 years. In December 23, notification has also been issued by GST saying that each case needs to be uh, looked into as per the facts of that case. But even then, the matter is not. I don't think the matter is going to be settled until Supreme Court issues a decision on this. That is point number 1A, Northern Operating Systems. Then 2A and 2B, if you see, currently under the Income Tax Act, Section 115A, the last subsection, it says that if any royalty, fee for technical services, dividend or interest is paid by an Indian entity to a parent company, and tax is deducted on it as per the act, which is 20%, then there is an exemption for the foreign parent company from filing income tax return in India. So the way that subsection has been written, it gives an interpretation that if tax is being deducted as per treaty rate, which is 10 or 15%, DTA rate, then that exemption is not there for the foreign investor to file return in India. So these are on these points that you're seeing on the screen. Representations are being made by the Japan Chamber of Commerce and Industry in India, of which we are also a member, that is tax committee, to the Indian government that please exempt foreign companies, parent companies from requirement to file ITR in India. Such kind of thing is there because if you're availing treaty rates, otherwise it becomes mandatory for those companies to file ITR in India. Just because the withholding tax rate is being deducted as per treaty and not as per the Income Tax Act, it is unfair for the parent company to file ITR in India. And similarly, in such situations, they also have to file the 3CB or the TP certification in India. Then in fourth point, if you see, the JCCI has also made recommendation to government that a tax rate applicable to foreign companies should be uh, similar to that of Indian companies. So we see that it's 35% in case of foreign companies, and in case of Indian companies, it's 25%, especially for project offices which have a limited period of time. If they are taxed at a higher rate, it doesn't make sense for the foreign companies or the Japanese companies. And then 12th point, if you see, exemption from construction fee in certain cases. So like the bullet train project, these investments, these projects in India. See, Japan will set up the Shinkansen project, the bullet train project in India, but the technical know-how of running it is something which they will transfer to Indians so that Indians can take it ahead in future. And that technical transfer, it takes a lot of time. And when the engineers from Japan are coming and staying in India to give a download of that knowledge to Indian contractors, that is constituting a permanent establishment for the parent companies in India, which should not happen. There should be an exemption on this matter to the Japanese companies. This is again a recommendation. Then simplification of PF refund procedures, adjustments of income tax refunds. So many issues are going on. These are practical ground related tax issues which you're seeing in case of Japanese companies, and similarly they'll apply for other foreign companies as well. Key compliances in India: incorporation, accounting, bookkeeping, payroll management, social security benefits, labor law, professional tax, statutory audit, tax audit, special audits, internal audit, forensic audit. There is a lot of opportunities for forensic audit, at least in Japanese companies I've seen, because there is always some or the other employee in India who is trying to adopt unfair practices. So the management decides to do a forensic audit. A lot of scope for forensic audits in Japanese clients, at least for sure. Company law compliances, tax compliances, annual ITR, withholding tax, personal tax. Here, when we talk about personal tax, the method of calculating tax liability of expatriates is quite different from that of Indian employees, because usually the tax liability of expatriates is met by the company itself. So there again, an opportunity lies for us as members. And Institute has issued a beautiful guidance note on expatriate taxation in India, transfer pricing, GST, foreign exchange law, business-related registrations, compliances, shops and establishments. So a lot of opportunities for us as members to cater foreign businesses opening up entity in India. Now, these slides are about a manufacturing company which wants to set up a presence in India. I'm not going through that in detail, otherwise it will take too long. These are typically for how the processes which they have to undergo. We have been advising clients on doing the legal due diligence in India for the land, negotiation, appointment of agencies, the agent who will help them buy the land, all the negotiations, discussions. They tend to rely on the finance guys as trusted business advisors. So there's a lot of opportunity there. Roadmap for an inorganic project. This is how a typical merger and acquisition a project works. I mean, how foreign company, if they are buying an Indian entity through an inorganic route, which we talked some time back, the signing of an NDA, exchange of information, site visit to India, meeting with promoters, signing of EOI, performing the valuation, negotiation, signing of term sheet, due diligence, signing of agreements, deal closure, and PMI, post-merger integration. Common pitfalls and market entry advice for foreign investors. First is we have seen that they underestimate regulatory complexity of India. We know India has a very complex uh, framework. I've seen companies, foreign companies, saying that in Singapore it takes 1 day to form a company. Why are you taking 6 months? What do I answer? I don't know. Inadequate market research, hasty planning, just set up the illegal entity without doing a proper market research. See, it's easy to form an entity, it's difficult to run it, and all the more difficult to close it. I think in case of a private limited company, if you form it in India, then before winding it up, I think the balance sheet needs to be made zero, and there should be for 2 years it should be doing no business. Something that kind of requirement is there. So it's easy to form an entity, but it's difficult to close it. So please, our advice to foreign investors should be do adequate market research before deciding to set up your legal entity in India. Overlooking cultural differences. Again, this is something which I've been facing for a long time. The way of doing business in India, when you work for Japanese clients, they even see the 0.00 rounding off also is sometimes not acceptable to them. Right? This is cultural difference. The way of working, they go lot into details. They may take a lot of time. They are a bit slow traditionally, but then the reason for that is that they do a very detailed advanced planning before they decide to expand overseas. In Japanese companies, there is typically a department which is called Overseas Planning Department, which is responsible for expansion globally. And here we need to understand that usually India is not the first country which an overseas business will choose for its expansion. So usually it's India is usually fourth or fifth or sixth. So typically in case of Japanese companies, what I've seen is they have presence in US, China, Vietnam, Thailand, and then they choose India. You'll hardly come across any Japanese company which has chosen its first overseas base for expansion as India. So this also helps, because once a company has established presence in other parts of the globe, they have an understanding of the issues which arise in overseas expansion. And that situation, it is easier for us to explain to them vis-a-vis a situation in which India is going to be the first country in which that particular company is going to expand. Choosing the wrong local partner, whether it is business partner or consulting partner, ignoring taxation and legal nuances in India, underestimating infrastructure and logistics challenges, lack of localization, insufficient investment in talent and training, very important. Over reliance on government incentives. So government can provide incentives, but that will be 10 to 15% only. Remaining 85%, you have to rely on your operations, your study, your resources. You need to educate the foreign investors about this very clearly. Neglecting IP protection. Market entry advice. Please understand the regulatory landscape. Please conduct thorough market research. Please develop a robust India entry strategy. What you want to do in India exactly, and build a plan for next 5 to 10 years. Then take the decision to set up your legal entity in India. This should be our advice to foreign investors. Localized offering, select reliable local partners, plan for taxation and financial structuring, navigate labor and HR regulations. Labor is a big time issue, especially in Japanese companies. What happens, typically for these expatriates from Japan, they come to India for a period of 3 to 5 years. In some cases, they stay for a very long time. But what practically I've seen that the company was established in India, manufacturing entity in India, established from 1995. People working in India, the head of departments are all Indians, having a strength of there are 1400, 1500 people, 400 crore turnover. Now, what happens is the people are there, the Indian people. I've seen Indians working with Japanese companies for years 15, 20, 25, 30 years. And the expatriate, the boss keeps changing, all right, for every 3 to 5 years. So there is you could call it an ego issue or something like that with the Indian employees to report to the new boss. The Indian employees, we start thinking that, we are the boss of this task. Why should we accept instructions from a from a new person who has just joined us? And that person has its own thought process. So it's a clash of thought processes, a clash of egos that often leads to difficulty. So navigating labor and HR regulations, that's very, very important in case of foreign investors, especially with Asian countries. Protecting IP, plan for repatriation and exit, staying updated on policy changes. Now, what are the opportunities for professionals? India entry, you can advise the foreign investors on what form of legal entity they should form in India, whether they should go for organic expansion or inorganic expansion. If they choose organic expansion, what are the activities they want to do in India? How many people they want to hire? What is the top line, all right, which they are looking at? And then you can suggest to them whether they should form LO, BO, PO in India, etc. Assessment of legal entity options, setting up of the legal entity in India, the company incorporation or the LO, BO, etc. Resident director, registered office address services, you can provide these services. But be very careful again, as I mentioned a few minutes back, do not take up directorship or authorized representative of any hanky-panky company. Do a good research before offering this service to any company. Tax and regulatory advisory. Compliances, of course, which happens to be our daily bread, accounting, HO reporting, MIS, financial planning analysis, taxation, compliance, litigation, legal, secretarial, regulatory. payroll, labor laws, corporate policies, audit support, loan staffing. They need support from us, all right, for sending temporary manpower to work whenever there is a need at their end. FRRO, which is foreign registration, uh, some R and office, FRRO office. So whenever an expatriate comes to India, within 14 days they need to be registered with the FRRO. That is a service you can provide. SVB, Special Valuation Branch Proceedings, in case of customs. It is a very common feature when this for the Indian subsidiary to import goods from parent companies or other overseas enterprises. So you can offer your services for getting an SVB order, transfer pricing, of course, within assurance, stat audit, tax audit, internal controls over financial reporting. This is missing many a times because the MDs, the expatriate MDs, they don't care, and then frauds happen, and then they get bothered. So we should explain to them that, see, have internal financial controls or internal controls of financial reporting. The legal side is one side of it, the requirement for directors to report, the requirement for auditors to report, but how it helps in creating a robust governance structure in the Indian subsidiary is something which we can explain to the foreign investors. Forensic audit, due diligence, valuations, ESG, CBAM has come up. So whenever an Indian company is exporting to Europe, the requirement for carbon border adjustment mechanism reporting, it's a new area. We can provide that support. Within HR, they reach out to us for HR services also. We need to have the right partners, of course, but professional employer organization, EOR. EOR is not exactly an HR service, but what it means is if a foreign company it wants to uh, first it wants to test, like we received requests from a Japanese bank some couple of years back. They first wanted to send one person to India to do a basic study without setting up of an LO in India. So what we can do in that situation is we can be the professional employer organization or the employer in record for that particular person, and whatever are the disbursement salaries and reimbursement etc we pay to that person in India, that plus a certain markup of our fees we charge to the parent company. That is called professional employer organization or EOR. Secondment contracts, right? When this expatriate is being sent to India, their proper contract, especially after the NOS decision, has become very important. Making up employment handbook, recruitment, labor, employment, industrial relations, negotiation. But of course, see, these services, they have a side of HR to it, they have a side of law to it. Be careful, do not compromise on the deliverables because you're representing yourself as a chartered accountant and we need to uphold our institute's name. So take up any service only if you're confident and sure of delivering quality on that, not otherwise, please. Within GCCs, build, operate, transfer. So what now companies have been doing, overseas companies, they ask you not to just set up the legal entity in India and do its compliances, but they also ask you to run it for a certain phase, maybe 1 year to 3 years, build, operate, transfer. You build their company in India, you operate it for maybe 6 months or 1 year, and then you transfer it to the parent company. This is very upcoming area for GCCs in India. Basically acting as a one-stop solution provider for foreign companies in India. Issues faced by professionals, I'm talking from my experience, we sometimes miss a holistic or a approach or a business perspective. What the client is exactly wanting, we really need to understand that. And then we need to marry it with the legal regulations in India. So understanding the business perspective of any particular need of the client is very important. Support in planning, UBO declarations, notarization apostille, AR resident director, so DMAT. In these all areas, these are service offerings also, but then there are issues that you face as professionals, and you need to have patience there. You need to give the correct advice there. So feel free to talk to your fellow professionals. There's no harm in borrowing knowledge, but yes, there is harm in giving wrong advice. Coordination with third parties. They often engage us chartered accountants as the main point of contact. They ask us to, even talk to the construction agency. There are clients which have asked us to talk to the construction agency which will making their factory in India, which will their agent in India who is doing the deal, because they rely on our knowledge and prudence. So we have an active area to play, not just as financial people or auditors, but also acting as a one-stop solution provider for these foreign companies looking to expand in India. That's it. Thank you. That's it from my side. I hope I've been able to explain things in a lucid manner. There were many things which I wanted to talk, but could not because of the time constraint. If I have even landed up sharing 60 to 70% of what I wanted to, I think I've done a fair job. That's it from my side. Thank you so much, Smitaji, Gunjanji, and
Yeah, thank you, Manan. Yeah, we have few questions. I'll be taking up that with you. One of our viewer has asked, how do we get a network partner in important jurisdiction like US, UK, Netherlands, Hong Kong, Singapore? How this will help newly qualified CA?
see, network partner is something which you need to be very careful about, because of late, what has started, I've noticed it that people are starting global networks, people based in Europe and US, just to make money, to earn membership fees. That is not something which is going to help. And the answer to this question is networking. You need to be present, you need to talk to people, you need to, but be careful. See, any network that will only give you a platform, all right? But to make use of that platform is always up to you. So, how you find a network, there is no fixed answer to that. Networking is the answer. Be in touch with people, but be careful. Don't go with very high expectation that it will put things on a plate and give it to you. No, it will just give a platform to you. It is after that it is your hard work to reach out to the members of that network, explain how first explain how why they should invest in India, and then say why they should appoint you. Don't start talking about first why they should appoint you. Let them see the value of setting up a legal entity in India, and that is how we should take it ahead. So that's my take on the matter.
Yes, very well said. Then next question is, what is the common tax related mistake you see foreign companies make in their first year of operating in India, especially concerning GST and transfer pricing?
So in terms of transfer pricing, there's one very interesting case I saw. Uh, the a branch office was formed in India, and there was a capital infusion in the Indian bank account. The money was coming from head office, and typically this was around 2013, I think, when the date for filing ITR in India for branch office was 30th November only. If TP is there, then date is 30th November. If TP is not there, earlier it was 30th September, I think. Now it is 30th October, earlier it was 30th September. So, and there was loss in that BO. So, what we did, what our client did was, it took us conservative position, and it filed its ITR in India before in the month of November. And we and we the client also filed its 3CB also as a good citizen, as a matter of abundant precaution. The way department saw it is that you had losses, you could not file your ITR in time, it was not ready by 30th September, and hence to get the benefit of another 2 months additional time, you claimed that you are liable to transfer pricing regulations, but whereas you are not liable to transfer pricing regulation, because the only transaction which has happened between parent company and the India branch office is putting of capital money to India, and hence it levied penalty on that particular client, and there were no transactions, the business operations was zero. our client ended up paying up 76 lakh rupees as penalty. The penalty was upheld by the CIT. The penalty was upheld by the tribunal. But this was such a, I mean, we were not representing that client on the uh, tax part, but this is one example of one mistake which I see in cases of transfer pricing, an example. And lack of proper planning, documentation, I think that is what could lead to severe exposures. Now we have to be very careful in case of secondment contracts, especially after NO's decision. So in the first year of operation, see, operations do not start full-fledged in the first year, so GST issues are not likely to arise. But we need to maintain the documentation very properly so that it limits the exposure for subsequent years.
Right. So the next query is, please elaborate on practical challenges and timelines involved in repatriating profits from an Indian subsidiary to a foreign parent company.
So repatriation of profits, usually, if the taxes are paid in India, then I don't think it takes more than a month or so, something. And typically, most of the cases that I have seen, they, retain the profit in India. Otherwise, of course, if you're paying as by way of interest, then you have to keep in mind the thin capitalization rules. You have to limit it up to that. Those kind of issues needs to be kept in mind.
Next question is, beyond the major metropolitan cities, which tier 2 or tier 3 cities are emerging as attractive destination for foreign investment? If you have any idea about that, like I think Gift City in Gujarat is coming up as
Yes,
another
absolutely. And that's a very
GCC.
nice question, I would say. So, if we talk about this question the answer has two parts. One is service industry and another is manufacturing industry. So if we talk about service industry, other than the tier one cities, or maybe metropolitan cities, we can say, I see Bangalore and Hyderabad coming up as major destinations for foreign investment. If we talk about manufacturing industry, so Neemrana in Rajasthan or MIDC in Maharashtra or Sanand industrial area in Gujarat, these areas which are around say 100, 150 kilometers range from the main airports, they are coming up. Tamil Nadu is in the Sri City and other areas, they are getting huge investments. If we are comparing the land price between North and South India, typically, the way I have seen, I think it's around 50%, broadly speaking, in South. So South is drawing a lot of investment from a manufacturing perspective. There are around 12 Japanese industrial townships in India, all across different states, and they have all the ecosystem. Like if we go to Neemrana, around 100 kilometers from Delhi or Gurgaon, it's called mini Tokyo as well. You'll find Japanese restaurants, you'll find Japanese theaters and whatnot. Birds of a feather flock together. So tier two, I
Right.
mean, these areas around 100, 150 kilometers within the range of tier one cities are attracting a lot of investments from the manufacturing sector.
Okay. You talked about data privacy in your slide. With evolving data privacy laws in India, what are the key compliance points for foreign technology or service companies that we should be aware of
So
as CA?
this is a, uh, I think this is a question which is better answered by a lawyer. So I would refrain from answering it, to be honest.
So we'll move to the next question. Like you mentioned, there are a lot of GST and tax disputes. Um, can you discuss the effectiveness of dispute resolution mechanism in India? Is there any, dispute resolution mechanism for foreign entities?
So, mutual agreement procedure is there, but then the stake is, if that is relevant, if the stake is very high. I've worked on mutual agreement procedure for an American company and one for a British company in the past. So there, but then the stakes are very very high. Both the competent authorities of the two countries, they sit together, they discuss, and they arrive at a settlement. So that's one effective route, I would say.
So my last question is a lighter one. Like from cultural perspective, what is one piece of advice you would like to give to a foreign manager leading an Indian team for the first time?
Very interesting. Uh, First advice I would have is to attend the language learning courses which are organized by our institute.
Right.
So, our institute organized the first Japanese language learning class in 2017. The Committee of International Trade, they organized it, and I'm really thankful for that. They organized it with the Japan Foundation. I still remember I used to go to the institute, the first floor. There were 20 of us. We were the first batch, and the course is organized very nicely by the study material. It's like what we used to study in class 1 or 2. It has those comics, the speech balloons, and we really enjoyed that. And of course, when the institute organizes it, it keeps in mind that we are working professionals. So the classes are organized on weekends so that you can devote good enough time. And just to share, I passed JLPT N5 exam a couple of years back, and I would like to give a major credit for that to our institute. JLPT stands for Japanese Language Proficiency Test. It is similar to IELTS, the course which is there for English. Similarly, for Japanese, it's Japanese Language Proficiency Test. It is conducted by the Japan Foundation globally, and it has 5 levels: N5, N4, N3, N2, N1. N5 is the most basic, N1 is the most advanced, but it takes efforts. Even N5 takes a lot of efforts. I would say akin to a CA foundation with my efforts it takes. And I did that course. I really enjoyed it. Now I'm planning for doing N4. So that is one of my suggestions. Please do take up these classes which are organized by the institute. Secondly, when it comes to cultural differences, you watch videos, Netflix, you obviously watch. Like when we meet Japanese people, example, I can quote Japanese because that's where I've been involved a lot. You wish them in their language, all right? You wish them konnichiwa, it's when you say hello. You
Mm.
wish them arigato gozaimasu, which means thank you. When you bow to, the way you greet a Japanese person is that you bow, and when you bow, you look at the feet of the person. You're not supposed to have eye contact with that gentleman, and your spine should be straight. And there is a degree of bowing also. If you go a bit more into detail, you bow 15 degrees, 30 degrees, or 45 degrees. So you bow 15 degrees when it's a informal relationship. You bow 30 degrees when it's a formal relationship. And when you're supposed to show a lot of respect for the other person, who is supposed to be a very senior person, then you go 45 degrees. These are the intricacies, how you take it up. Be very punctual when it comes to Japanese. If you have a meeting at 10 a.m., be there at the venue at 9:55 a.m. Meeting time agreed at for 10 a.m. with Japanese, it means it is implied that the meeting must start at 10 a.m. It should not be 10:01 a.m. So be there at 9:55. These are cultural things which you should take care. If you're working with Spanish, I don't know how the culture of Spain or Germany goes, but uh, I still remember for one of our clients, again, an interesting tale, an anecdote. It was a German client, and I was working for it in 2013, and it was Diwali period there. It's a small organization, 4 or 5 people of us were there, Indians, and the German MD, he was outside. So uh, the ladies in the team, they made swastik on the floor with rangoli. Diwali time tha. and beautiful, everything, very happy. Then the German MD stepped in. He's a nice person. He said, remove it immediately. Why? Because it resembles the Nazi symbol of Germany. And if somebody takes a picture and send it to head office, then he said that my job will be at stake. So when you're working for German companies, you need to keep that in mind. So you gradually improvise, you learn from the surroundings whenever you're working with a multinational company.
Truly, Manan, I connect with your thoughts that once you said that Japanese are very particular about rounding off of numbers. This is quite true because they look into 0.0001 as well in when they are doing, presentations and all that, and they remember the numbers.
When you
So,
are translating, all right, my inbox has more Japanese mails than Indian mails. So when you're doing a translation, check it from 2 to 3 websites. Do not rely on the translation from one single website. Do it on Google Translate. Do it on DeepL.com, DEEPL.com, because the meaning could change with the translation, and hence your advice
right,
could change.
okay, right. So, thank you, Manan, for the incredibly insightful presentation. You have provided a clear, comprehensive roadmap for navigating the Indian market, and I'm certain our audience has found it immensely valuable. The depths of your expertise and practical advice you have shared have been truly exceptional. I also want to extend a huge thank you to our audience for your active participation and thoughtful questions. Your engagement has made this session very more enriching. We hope this webinar has equipped you with the confidence and knowledge to take our next steps towards entering the Indian market. Thank you once again for joining us today. Thank you.
Thank you, everybody. Thank you, Smita. Thank you.
Thank you.
Thanks a lot. Bye. Yes,
हाँ
yes.
जी